Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. I am the Chief Investment Strategist at Standard Chartered Bank India. We've just released our quarterly India market outlook titled Positioning for Volatility. In today's podcast, we summarize a key question: how do investors position for the near-term volatility? Indian equities have been the notable exception in third quarter of this year, as robust high-frequency macro indicators and strong corporate earnings delivery amid a stable policy environment has helped a broad-based recovery from March 2023 lows. Global financial markets, however, have remained under pressure in third quarter as weak leading economic indicators, tight financial conditions, and rising bond yields begin to cloud growth and earnings outlook. Bond yields have reset higher as hawkish central banks and rising fiscal deficits have fueled expectations of an extended policy rate pause. So what does it mean for the near-term outlook on domestic risk assets? Well, in our view, the risk of a near-term pullback in domestic equities is high given stretched valuation premiums, slowing foreign investor inflows, and a potential surge in inflationary pressures. Against this backdrop, we favor selective risk-taking within major asset classes, sectors, and quality segments while maintaining balanced allocation across equities, bonds, cash, and gold. We propose 3 ways to do this. First is to balance risk-reward within equities. Indian equities have bounced back strongly over the last 2 quarters of 2023, significantly outperforming its peers. Broader markets have surged, outperforming the large-cap peers, driven by strong tailwinds from superior earnings delivery, more reasonable valuations at the start of 2023, and expectations of lower bond yields. We reduce mid and small cap equities to a core holding from overweight. The main driver of this shift is risk management rather than a change in underlying fundamentals. While the relative earnings outlook is still superior for mid cap and small cap equities, the sharp divergence in performance in 2023 year to date has turned valuations rich for mid cap and small cap equities. Further, negative EPS revisions in the third quarter of 2023 and tighter financial conditions amid a higher for longer policy rate outlook are headwinds. We continue to see value in multi-year structural themes which include manufacturing and infrastructure in India that are beneficiaries of the sustained investment cycle revival and numerous supply-side reforms to improve efficiencies, ease of doing business, and competitiveness of domestic sectors. Second, we focus on bonds where we still see attractive yields. Within our core allocation to bonds, we retain an overweight on medium and long maturity bonds. We see the recent surge in bond yields as an opportunity for bond investors to lock in attractive carry, especially in the medium and long maturity bonds, given the following. First, attractive absolute yields, given the 5-year and 10-year Indian government bond yields are tracing closer to their 10-year average. Second, lower likelihood of policy rate cuts by the RBI in fiscal year 2024, given the RBI's focus remains on managing system liquidity amid still elevated inflationary pressures. And third, improving medium-term demand outlook post India's inclusion in global bond indices. We prefer high-quality corporate bonds such as the AAA rated bonds, as we see a favorable risk-reward relative to government bonds given 3 reasons. First, they offer an attractive absolute yield. Second, current spreads are likely to narrow amid improving corporate profitability and strong demand for high-quality issuers. And third, their returns are likely to be less impacted by changes in the RBI's policy rate stance. Now we focus on third aspect, which is to remain diversified. We expect market volatility to remain elevated over the remainder of 2023 as investors balance downside risk emanating from increased likelihood of major central banks staying on an extended pause, a resurgence of inflationary pressures driven by higher crude oil prices and geopolitical tensions, and waning consumer confidence, slowing economic growth and corporate profitability, which is a consequence of the unusually rapid series of rate hikes. Thus, we maintain our core allocations to gold and cash and liquid alternatives as these asset classes have historically played the role of portfolio diversifiers. Gold remains a preferred portfolio diversifier as it has historically outperformed in recessions and displayed its safe haven properties during crisis. This increases the appeal of gold as a hedge against a backdrop of elevated macro uncertainty. Continued central bank buying, household and investor demand are other key drivers to support gold. Coming to potential risks to monitor, they include central banks continuing to hike rates to counter persistent inflationary pressures, narrowing Indian bond yields differential with US and other developed markets, leading to derating of Indian equities valuations, shocks to domestic growth from global growth slowdown, deteriorating external accounts driven by higher crude oil prices, and potential surprises in state and parliamentary elections. That's it in this edition of the podcast. Do reach out to your relationship manager for a copy of our India Market Outlook. And thank you as always for listening. If you enjoyed this podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.